And we're looking at the ES expected move, Tom. We're sitting at 54 points. That's unchanged from last week and unchanged from the following 4 weeks prior to that. S&P's basically, their volatility has not changed at all on a weekly basis for the last 5 or so weeks. 1.1% is the expected move for the rest of this week.
Yeah, I mean, volatility is really. I saw the VIX was. The VIX is up a lot, but the volatility futures aren't up anything today.
I think the cash VIX is up just from a readjustment because it always goes to the 30-day period.
Yeah,
That's correct.
Not meaningful change. So yeah, we'll see. I mean, last week obviously was a pretty dry week until Friday. So do you ever fade the expected move? Like, do you ever trade it to both sides, or you always trade it to the inside bias? Like, do you ever make a trade that you were like, okay, this is too small of an expected move? We're gonna, I don't know.
No, I think it's too hard. You can't flip the cards over.
Yeah, last week it would have worked, but only if you held through Thursday afternoon and then Friday.
Yeah, I mean, it's too hard to flip the cards over. No, I'm not a premium buyer.
All right, let's go to the next slide. That is basically the same thing we've seen. Okay, so this is kind of interesting. Tom, you're not going to like this slide, but it is the facts. I know you love the facts. So since the January 2022 high in the S&Ps, the S&P and the NASDAQ are up just a smidge, actually. I know a lot of, we tend to look at the market, from the lows, and obviously up quite a bit from the lows, but since 2022, S&P is actually only up like 8% over the last 2 years and 2 months. Nasdaq's up a little bit more, but they're actually on pace roughly the same return, from the highs in 2022, the January 2022 high. Of course, recent divergence, obviously Nasdaq is winning, but it has had a larger sell-off in 2022 as well. So you kind of got to put both in perspective. But these are the numbers, because we haven't really discussed these after the bear market and then going into this bull market. So kind of wanted to show what it looks like since the last all-time highs, which when you put that into perspective, it doesn't look like all that much of a huge move.
Obviously, I mean, that's a little misleading, because when you think about 1,000 points up in 3 months, that's a lot.
Of course, it's misleading, but everything's misleading. It depends on the time frame. Like it's not.
Right.
Depends on the time frame. I mean, it's not. It's misleading, not in an evil way. It's to show you, that depending on the time frame you look, you get a very different result of the returns, and especially the divergences. Now the Russell is still down significantly greater than the rest of the index. It's about 18% spread since the high in 2022. So that's the one thing I think that's significant here is the Russell's still underperforming regardless of what the market's been doing over the last 2 years. The Ivy ranks calculations are getting quote unquote tighter. So I wanted to explain this because we're going into a period where we are about to get a 1-year period where the VIX is going to be trading in a range that's less than 10 points. And the reason that's important is, so I highlighted basically the high of the VIX over the last year, which is that red dot last March, and the low of the VIX, which was just in December. Because IV rank uses the high and low calculation of the IV to figure out where we are in the range, once we get past March and April, and if we don't get any spikes in IV, we're basically going to be in a range that's so tight that any spike in implied volatility will give you an IV rank reading of like 50 or 60 or 70. And I mentioned that specifically because it's not going to be the same level of implied volatility as we had back in 2022 or 2023. So it's going to look like a very large spike whenever we get one, but it's not going to be actually as big as the spikes we got in the last few years. The only reason I mentioned that is because when we allocate capital, to positions when IV rank is higher, we want to still stick with IV, right? We want to look at IV to determine how much we allocate. Does that kind of make sense?
Yeah, sure.
So if we go to the next slide, this kind of ties into it. This is why we specifically look at capital allocation, and we've shown this many times before, but I think it's worth it to point out now as IV is still staying very densely wrapped around its lows, right? We look at it as capital allocation as a percentage of IV, not IV rank, because of this. Because, again, if we have another month of low IV, any spike in IV is going to make IV ranks so like 90, 100 in like a day or two. And we don't want to like shoot our capital allocation to like 50% or 70% just off of that. Because again, volatility is so low right now that it's going to take a little bit of time for it to kind of normalize into the IV rank calculations. It's just a little, we don't talk about this much because it doesn't happen often, but when we have this large streak of low IV, I think it's important to mention.
Just remember that is essentially what we call the most conservative case.
Right,
And,
right.
you know, the moderate case or the aggressive case, the moderate case is about 35% higher, and the aggressive case is 50 to 60% higher, just to be fair.
Yeah, you can add, most traders hover around this plus 5 to 10 percentage points for each bracket.
Yeah, most traders are in the moderate case, which is about, like I said, about a third higher. And a lot of traders are in the aggressive case, especially with smaller accounts, which is about 50% to 60% higher.
Yep, and I just mentioned, and regardless of how aggressive you are, you can adjust the percentages, but we like to look at the VIX as the baseline.
Yep, that's fair.
Determine that. So whatever you want to be, aggressive, moderate, that's fine. Just look to the VIX more so than the IV ranks to determine that. All right, let's go to the next slide. Now, because of this low IV environment, again, we've shown this before. I think this is honestly one of the best pieces of research to remember and kind of put back into our memories as volatility goes down, because when we take a look at comparing like defined risk and undefined risk strategies, when we have a higher volatility, okay, we tend to get more bang for our buck in terms of risk to reward when, flip that, more return relative to the risk we take when we trade strangles, when we have higher IV. We take less risk, we make more money. That's why the high VIX, we have that blue bar that represents the strangle P&L adjusted for risk. When we get to the low IV environment, we get a little bit of a change, right? And what happens when the volatility gets low is that those same strangles that are very good in terms of risk and reward in high IV tend to not be as good in low IV. Why? Because the credits are lower and the outlier risk stays the same. So what we like to do, generally speaking, is trade more iron condors, because the risk that you take relative to the P&L is actually a little bit better when you trade those wider iron condors or medium iron condors compared to the strangle. That works better, obviously, when you trade high IV. And we know this, but it's good to remember, especially when VIX starts to trade at these very, very low levels. That make sense?
Totally.
Yeah. Okay.
That's a very nice slide.
Thank you, Tony. Appreciate it.
You're welcome.
Okay, let's go to the next and last slide. Actually, second to last slide. I want to do a little fun exercise as we wrap up here, Tom. Top 5 volume stocks. I'm going to list you. This is going to be like Jeopardy. We have the top 5 dollar volume stocks, last 5 trading days average, right? The last 5 trading days, the average dollar volume. For which 5 stocks, Tom? Can you guess one of them?
NVIDIA.
Okay.
That would be your 36.2 billion.
I think he slide, Tony. He must have. Okay, no, go ahead.
No, I didn't see any of your slides. I'm going to try to make this simple. Let me just look at my watch list here. I'm going to go NVIDIA number 1, Tesla number 2, Apple number 3. I'm going to go Microsoft 4 and Amazon 5.
All right, so we got NVIDIA, Tesla, Apple, Microsoft, and Amazon. Tony, any changes to that?
No, I'm going with my home team advantage of Tom Sosnoff.
All right, let's reveal it, John, in the last slide. NVIDIA, Tesla, Apple, you got the first 3. AMD, number 4, Microsoft, number 5.
So I messed AMD up with...
Microsoft.
I didn't put AMD in my list. I put
Amazon, which was up there. It was like number 6, I think.
Yeah, so I had 4 of the 5.
Yeah, 4 of the 5, and in mostly correct order, so that's great.
Yeah.
Can't trick you, Tom. Can't get one past you.
Oh, what can't he do?
Been doing this for a long time.